you bought Infosys share in India and directly bought Microsoft share in the US. Both the discount brokers claim to have zero brokerage fee. However, these zeros are not zeros in entirety. But here's the uncomfortable truth. Every zero brokerage trade pays somebody, and it is definitely not you and me. Zero brokerage is the biggest illusion in modern day trading. It is in this discussion where we try to peel away the layers and see what goes behind the screen so that we get a sense of to what extent a zero is a zero. Now let us take the example of India. In India, discount brokers usually charge a flat fee called as the AMC fee. And the stocks that we buy and sell is generally not charged as brokerage, apart from the taxes that we pay as STT, GST, etc. And the cost of buying a share, if it is not through margin, or cost of taking a position, if it is not through margin, is generally free. The margin role is more like taking a loan. So those costs don't appear. However, in case in India, if we are to do an F&O transaction, then there will be a separate brokerage fee. The brokerage fee of zero usually only pertains to stocks being bought and sold without any loan. In the US, the model is totally different. They have a concept called PFOF. Okay. The mental models that we can use to help us understand better is, in the context of India, let us take the example of, say, watching movies or any series in Netflix. In Netflix, we pay a flat subscription fee. And this subscription fee is valid irrespective of whether we see any series or we see all the series. In the US, the concept of PFOF is like we going to a tourist destination and hiring a tourist guide. The tourist guide, no doubt, will show us various places, but will also take us to places where we can buy mementos and then buy some refreshments. The pricing of the mementos and the refreshments would be at par to all the refreshments and mementos that are available in the market. However, behind the screen, what happens is the vendor owners and merchants would be paying a commission to the tourist guide based on the business that the tourist guide had brought into their premises. Similarly, in the US, we have what are called as the market makers. This is a term that we don't use in India, but it is very prominent in the US. The role of the market makers, in fact, many traders in the US themselves do not know. It is like that of a tourist guide. What they would do is, when a discount broker, let us say like Robinhood or First Trade, when a user places a market order, the order does not go to the New York Stock Exchange or any of their exchanges.
Unlike India, where we have two stock exchanges, the Bombay Stock Exchange and the National Stock Exchange, US has a cluster and a variety of stock exchanges. The prominent one being New York Stock Exchange, but apart from that, you also have the Nasdaq, the CBOE, the IEX. You have many venues. And hence, when an order is placed by a user, typically there are several competing prices that are there across the markets. So, for instance, let us say a user uses a Tasty Trade app and places a market order to buy a Microsoft share. There is something called as the NBBO, which looks at all the price across these varieties of marketplaces and determines which is the least price at which Microsoft share can be bought and what is the least price at which Microsoft stock can be sold. This NBBO, or the National Best Bid and Offer, creates a limit on what the price range can be. Once a Tasty Trade trader places a market order to buy Microsoft, the National Best Bid Offer will create a bound on what the Microsoft share buy price can be. Order through Tasty Trade will go to one of these market makers, either Citadel or Virtu or Jane Street, and one of them would take up the market order request of Microsoft and place a slightly inferior pricing, but well within the NBBO norms, so that the order can be filled by Tasty Trade. This extra commission that the market maker has made will be shared with Tasty Trade in due course of time. So this small piece of commission that the market makers make and a smaller portion of commission that is being passed on to the discount broker goes unnoticed by a retail trader when they are using a discount broker in the US. Usually, the order of such a commission would be the third or the fourth decimal place. So what is PFOF? PFOF is an acronym for Payment for Order Flow. It's a practice where brokers get paid by market makers to route their customers' order to those market makers instead of directly to the stock exchange. The market maker earns a tiny profit on the bid and ask spread and shares a portion of that profit with the broker as payment for order flow. The most prominent market makers in the US are Citadel Securities, Jane Street, and Virtu Financial.
It is usually the order of second or third decimal place, and so when a market order is placed by the trader, they may not even notice it. However, when millions and millions and millions of such transactions takes place daily in the US market, the numbers add up, and a good portion of these numbers as commissions would go to the broker. Hence, in the US, if we were to use a US broker directly, we would be getting an additional overhead of a couple of decimal places, but end of it, you would be accepting the stock or you'll be able to sell the stock at the market rate.
Assume in India, a trader places a market order of buy of an Infosys share using a discount broker like Zerodha. The trader would a priori select whether the order needs to go through a Bombay Stock Exchange or a national stock exchange. Unlike in the US, where there are a pool of exchanges and then an NBBO needs to be created, and you have a market maker to come in between and quote a price. In India, directly, all the brokers, whether discount or otherwise, would have to place the market order in the pipeline to the National Stock Exchange. The National Stock Exchange does the consolidation based on the algorithm that it has, so that the best price gets to the customer, the trader, by the National Stock Exchange itself. The filled order is being expressed through the discount broker app to the retail trader. In the entire journey of the retail trader in India using a discount broker, the price of buying and selling a stock, not in margin, would be zero. However, the annual maintenance contract would be a fixed price that the trader would have to pay.
So, to sum it up, the concept of PFOF is unique to the US markets, and in India, we don't have the concept of PFOF when it comes to the buying and selling of stocks. In the F&O world, it is slightly different in India because there, in some occasions, we do have a market maker. For an Indian investor who invests in India, vis-a-vis the Indian investor investing in the US stock market through a US broker directly, the overheads, if we are to analyze, it is actually in the order of second decimal place. But it is an important analysis for us to make. The same holds good even for a non-residential Indian or a person of Indian origin who do not live in the geography of India, but from any other foreign land, including US, when they attempt to directly invest in the Indian stock market through a discount broker of India, they too would notice that the overhead for buying and selling a stock is probably in the second decimal place. So that is not where the real overhead is. Next video, we will cover where the real overhead is. So here's the clue. The real overhead is never in the trade. It is actually in the pipes.